Our next presenter, some of you may know, John Gustavson. John has a master's in chemical engineering and in geology. He consults in the areas of gold and precious metals, base metals like copper, lead, zinc, iron, and aluminum, uranium, oil and gas, coal and coal bed methane, industrial minerals, evaporites, sand and gravel, and geothermal energy. Core competency is in geology as applied to mineral resources, with adjunct supporting in engineering, economics, and appraisal based on his 45 years of experience. He was the co-founder of the American Institute of Minerals Appraisers in 1991. Let John start with this paper.
Thanks very much. I agreed to give a paper on case history and to maybe keep it in the oil and gas end so we could have an oil and gas oriented paper this afternoon. So that's what I'm going to do. First of all, I want to thank the owner of the property that I appraised, Mr. Carlson in Illinois. He owns this property in North Dakota, and he was kind enough to give me permission to give this case history, including numbers and so on. My objectives are to try to get through the early stuff and then try to reach out and treat one of the several things that are kind of new or difficult or can give us some problems so we can maybe learn a little bit. And in this case here, it will basically be apportionment, as you see down here. What we will go through is where it is, the purpose, description of the property, the highest and best use of it, any reserved resources, choice of the various appraisal approaches, estimating the fair market value, and then go into the apportionment among the or between the executive rights, the right to actually sign leases, receive bonuses, and so on, and the non-participating royalty interest, which doesn't have the above rights, but which has the right to cost-free to receive income from the production. How do we handle that? So first, the location of the property, and in this particular case here, we are talking about, excuse me, go too fast here. We're talking about a property in North Dakota. North Dakota is here, the Canadian border here, Montana over here, and South Dakota down here, of course. And if we take this particular county, Pierce County, blow it up, so it is about here, and the property is located here in Pierce County, not too far from Bodino, in Bodino County up here, but way up there, if you say. And of course, our particular interest is how does this fit into the Williston Basin, which is a focal point these days for a lot of oil and gas development. But some of you already can see that we are pretty far east, out at the outskirts of the basin, which lies about like this. The purpose was first to estimate the fair market value of the about 1,000-acre property, and then subsequently to apportion that between those two other subsidiary property rights. And then the client, Mr. Carlson, it was his intent to gift part of the mineral property to his heirs or to trust for his heirs, so therefore the fair market value and the apportionment had to be done under prevailing IRS rules and regulations. And just similar to the paper that Mr. Knobloch gave this morning, we have to work under such rules and regulations, particularly these days where there may be a sudden increase in property value, in the fair market value of the property, and then also try to understand how does this apportion out between the right to receive the bonuses and the right to receive the cost-free royalty if and when down the road there's actually production from such wells. The property itself easily, of course, can be to say, oh, there's a whole bunch of quarter sections here, they all add up, section townships and so on. So one way is to look at the legal description and get to the roughly 1,200 acres of property here. But more important is it also to understand that it's part of the fee simple ownership of Mr. Carlson's overall property, which included both the surface in yellow here, and also is it presently leased or has it earlier been leased? What's the leasing status of this? Now, no oil and gas lease has been offered to Mr. Carlson within the last 3 years. So you can see it's a pretty dead area from that standpoint. Finally, there's no knowledge of any other mineral commodity, sand and gravel or gold or what might have you, of any current or anticipated value. But always remember that when you look at a property, you've got to look at the larger part of the property, the so-called larger parcel. So what is the larger parcel? Well, according to the Uniform Appraisal Standards for Federal Land Acquisitions, there's a good definition in there that a larger parcel, that which for us mining engineers can also be called the battery limits of the property. What is that? Well, it has to meet the test of, is there unity of ownership? Yes, in this case here, Mr. Carlson has the whole thing. Is there unity of use, of the highest and best use? Yes, that's also the case here. If we, in contrast to this, had a producing well right here, then this would not be the larger parcel. We would have this larger parcel as undeveloped exploration acreage, and we would have this larger parcel as a producing property. But in this case here, the whole of this is indeed of the same highest and best use. And finally, the test for larger parcel also includes the adjacency rule. Is there adjacency of the property parts? And although they do not have any common sides, these can be proved to be sufficiently adjacent to each other so that they all are part of a larger parcel. Now, had this been in Pierce County and this here up here in Bodno County, then we could not have said that they were the same larger parcel, and we would have had to make two separate appraisals, and then, yes, we could then add the value of those up afterwards. After having done that, and assured us of that, we of course look at the geology. Here we have the picture of the Canadian border, the Williston Basin going up into Canada, and this is the North Dakota and Montana part of the Williston Basin. And with a little bit of goodwill, you can see some of the important names here, like the anticlines and so on. But let us take the blown-up picture, USGS picture here, where they are telling us that we can divide it into assessment units. This was USGS assessing it for the amount of resources, not value, but resources in it. And here's the overall basin line, the blue line, and inside that they have some green areas here, which they separate geologically and call them various AUs or assessment units. And then going farther out, we have here a more, what they call a more conventional middle sandstone member assessment units. The key point is really that Mr. Carlson's property is away from the Bakken shale potential itself, where Bakken is both the source rock and the reservoir rock, and Mr. Carlson is all the way out here towards the rim of the basin and questionably on the edge also of that middle sandstone member AU. But we do note that the Bakken could have maybe sourced gas out in that area, and that could have gone into the overlying Madison Formation. To be a little more detailed about the geology, I have here the stratigraphic column, and we know that the most productive members recently have been the Bakken and the Three Forks, which are down about here in the chart, but they have not expelled oil all the way out to Mr. Carlson's property. However, there is some renewed interest in that general area in the spearfish up here, spearfish formation, which have some sandy members, and that is indeed also producing around the Canadian border and also up in the Boudinot County area. But there's still no closer production to the property. The closest is a Madison, here this is the Madison group, and there's some Madison production from the South Starbuck field, which is about 45 miles to the northwest. So the property is here, and then we go into Boudinot County here, and in Boudinot County there is indeed the South Starbuck field. At this part here, we see the whole development history of this area started out in the 1950s in these parts here, and then 55 it got into this area here, and then the Starbuck and this West Hope field came about in the period in the late 50s. The Newburgh area came in the 60s, and in the 80s we then started getting a newer play up here in this area. But you can see this is the last production 45 miles from this particular area. So it's very clear that from a highest and best use standpoint, we are way, way, way away from anything that can be called production of income from production in oil and gas. Let's look at the more detailed historical exploration activities. So there are no mineral resources presently known in connection with this. There was an offsetting well right here, the Zinn Havoc 13-32. It did penetrate down through the Bakken and the Three Forks and TD'd a little bit below that. It's about 10, 15 years ago. It was found to be dry, at least with technology as of that time. And so that basically disproved the existence of a local trap right in this area here, at least in what they did test, namely the spearfish and the Madison formations. The Bakken itself as a reservoir was not considered at that time. Now, what does this do? Well, at least that does tell us that there's a possibility for a petroleum system. We have the Bakken and the Three Forks, and we have the spearfish and possibly some Madison formation, even though this particular property does not have much potential, at least as was known about 10, 15 years ago. So what's the highest and best use? And you've seen this before. I think I used this first time about 20 years ago at a University of Tulsa course, Appraisal of Oil and Gas Properties, and we tried to show that as the overall value described by the size here increases as you go from the raw land through the petroleum systems, drilling prospects, commercial discoveries, up to producing wells, with the producing well obviously having the greatest value and the raw land having the minimum value, but then also an approximate relationship on a percentage basis between the oil company's value and the landowner's value, with the raw land being the area where the landowner has the highest value of the overall, because he has the opportunity to lease it out and lease it out and lease it out over the 10, 15, 20, 25-year period. He owns the mineral rights, and he consequently can have income from leasing it out. Whereas the oil company, we know that that's only a contract they have, and it may be a 5-year contract, for example, where they can explore. Maybe they can get to the point where they can identify a petroleum system. Lo and behold, it's worth more now. and then maybe they have a drilling prospect to drill. At that stage, we see that there's roughly equal value to the landowner and to the oil company. Once the oil company has kept putting money into it, kept drilling, made the commercial discovery and getting into the producing well, then we're getting to the point where the landowner gets his royalty, and consequently he has some value from that, and by now, hopefully, that's then the time when the oil company receives back its reward for all the risks it had taken and for the capital it has invested. Now there are tests for the highest and best use for this particular case, and since that's important, I broke it up into those four things. First, we have to ask, is it physically possible for Mr. Carlson's property up in this area here to be part of the exploration stage that may take place at this time? Considering the geology and so on, it's pretty clear that yes, it is physically possible. One point, of course, is that, hey, there were several wells drilled around there, so it's physically possible, even though those particular wells were dry. Next question, is it legally permissible? That's where we as appraisers, looking into the many different legal and regulatory codes and so on, in order to come up with, does the landowner have, would an oil company be able to get the permits to move forward into exploration and hopefully ultimately into production? The answer to that is also yes, it is legally possible. If you had asked me, what if this property were in upstate New York, and what if it was a shale property like we have up there, and what if the state of New York had a regulatory ban against fracking of horizontal wells? We might, as of the effective date, we might have to say no to going forward much beyond this point here. On the other hand, it's a regulatory thing, and government units can of course change their regulations, so that is another story that has to be handled in that case. Here, it was very clear it was legally permissible. Is it financially feasible? That means, is it indeed clear that if the two other criteria are met, can we expect a positive financial return? And let's remember, what are we talking about here in the highest and best use on the effective date? It is really the trading, the bartering, the promoting, the having the property, adding a little bit of value to it, and selling it on to the next party. So that is indeed a financially feasible use. We cannot at this effective date, this early in the stage of this land which barely has a petroleum system, we cannot say that the highest and best use is from the production of oil and gas. So maximum productive, we know that that's one of the various uses that can give the highest return. Key point in all of this is to remember the effective date. We have to look at a property valuation on the effective date and not what the property might be doing 2, 3, 4 years, 5 years out in the future after a mine has been developed or what have you. We put the highest and best use of the subject property right out in this place here. It's better than raw land, and we're beginning to see a petroleum system there. Now, therefore, the highest and best use is, as I said, aggregation of land, swapping, bartering, selling, purchasing, optioning, promoting, and all those early exploration states activities. Reserves, resources. Very simple. The well that was drilled nearby showed it was dry, first of all. So we're not talking about any reserves or resources, but there is a sandstone in the spearfish here per the geologist report, and there is indeed Bakken and Three Forks down below it. So there could be a petroleum system possibility, but no resources here. So we are basically valuing the mineral rights just in form of somewhere between raw land and a possible petroleum system. Here are the various appraisal approaches. Let's go a little bit through those. We cannot really use the risk discount cash flow approach. We know that there's absolutely no way of forecasting what might happen way out in the future, what investments we're going to make, if things were going to be found, and if they were going to bring any cash flow. Not reliable. Lease bonus approach, however, it's related in a way to a DCF approach if you look at it from the landowner standpoint. He can lease out his property occasionally, and he can receive bonuses from that. And if you count that up over the 5, 10, 15, 20, 25 years, then you can certainly see some value on that basis. Choice of appraisal approaches, again, sales comparison. We looked around, but we did not find any severed mineral property anywhere near the property where we could derive any kind of valuation from that. And finally, cost approach, we know that's not applicable because we had no data that told us, hey, what cost might have accrued up to date for this particular property. So we chose the lease bonus approach related to the DCF approach, as we know, and then we estimated the fair market value. We did it by the lease bonus method, and let's see, Ed Moritz in the room here. I know I saw him at lunch or something like that. Ed wrote a paper in 97 here, which discussed this method. In 96, there was another paper discussing that, and already in 1990, there was papers. So we have in the published literature, we have that bonus approach. It's fairly simple, but it's only applicable during early stages, reliable when we know these things here, and when they are relatively uniform. So we multiply that, as that literature tells us. They have found that the value of the mineral rights are basically from 2.5 to 3 times the bonus itself. So that works in this particular case. We found that rank exploratory acreage had this variation per acre in bonus. This is in the other end of what Tim Norbert talked about, in the Appalachians, Marcellus, where people are talking about thousands of dollars per acre. We confirmed the $10 per acre locally through various offices. So that particular property basically would lease for this amount. Then it's negatively impacted nearby by that dry well. So we chose the low end of the range, 2.5, and it's unleased. So we know that the owner would also, until he leases it out and gets money for the bonus, he would actually have his share of the overall value until leasing time when you get the bonus. So if we're going back to the chart on the various columns, if you go back there, the 71 comes out of that chart. So if we divide that 0.71 or 1% into this, we come up to a fair market value for the mineral rights owners of the whole thing at about $41,700. The apportionment itself is between the executive rights and the non-participating royalty interest, and the sum of these two is the overall fair market value. So basically, apportionment is going one step backwards and estimating those two complementary values. That value relationship changes with the highest and best use. During the early land play, it's obvious that income from leasing is more realistic because you can get that in the near future. So therefore, during that period, the landowners, the mineral rights, the executive rights have a higher value at that early stage than the other. And we can go on like that. And we then end up seeing that in the early stages here, it's kind of a 90-10 relationship on behalf of the executive rights over the NPRI. And in the other end here, when it is producing, it's clear that the executive rights have very little part of it because it's producing. It's helped by production. Chances for income from leasing are practically nil. Never zero, but practically nil. Whereas the income to the NPRI is up here. and this roughly goes up in that area too. So that is then done, apportionment between these two. We came up then with the executive rights were apportioned by 80%, right between the raw land and the petroleum system on the chart, and that gave us then an overall fair market value of about $33,000 for the executive rights. And what is important for Mr. Carlson, he was then able to donate or gift the NPRI at a relatively low tax value of $8,400 to his offspring. And this is what you have seen driving tremendous activity, for example, in the Appalachians, but also in the Bakken area, also in the Texas area, when people in the early stage of a play are able to apportion out the NPRI, which will have low value in the early stage, give that through the various IRS rules and so on, and then finally get to the bottom of having given a gift early. Now, we also had to look at other minerals, but none disregard this wonderful sandpile. We knew of no other minerals, but every right has a value, so consequently, the landowner may be getting something from leasing it out. We only gave it $1 per acre, so about $1,200. So the bottom line is that Mr. Carlson's executive rights and non-participating oil and gas royalty interest add up, and other minerals add up to about this amount here, and he could then file his tax returns for this. So now we've been through this, and I thank you for your attention. Thank you very much.
Well, thank you, John, and also thank you for obtaining clearance from your owners. There's some data. There's a very good overview of the entire project, key portions, walking through a evaluation and the appraisal process. The associates and new members will also gain some idea that, as you saw what John said, didn't just lose focus on just the subject. He overviewed the entire area, bird's eye view, relation to other activities in the area, historic going back 50 years, then zoomed into the local area. Discussion of apportionment and apportioning was very good too. So with that, I'll ask quickly, we're okay as far as schedule. Any questions? Would you please go up to the microphone and state your name?
So I looked at the multiplier of 2.5 to 3. I mean, I don't work in this industry, so I don't get the context. Maybe we can follow up offline on why a multiplier of 2.5 to 3 was used for coming up with the fair market value.
Are you talking about the 2.5 to 3 multiplier?
Yeah.
Okay. First of all, it was found from historical observations, which is why I gave the 3 literature sources. Okay? So that's my protection if I had to testify in court. But also, I did a reality check on that, because I then I assumed, what if the landowner, Mr. Carlson, what if he leased out the property and got the $10 per acre? So that multiplied by his 1,180 acres, that was 11,800. So he can receive that now. When can he get that again? Well, if he leased it out for 5 years, might be 5 years from now, or maybe there would be a delay of 1 or 2 years, all assuming that there's no other discoveries or anything like that. So he can lease it out again. Then I took the present value of what I would get maybe 5, 6, 7 years from now, the net present value. Then I did the same after 10 or 12 or 13. Put that back. And I did that up to about 20, 25 years ahead. So from the landowner standpoint, he obtains the sum of those net present values. And lo and behold, that turns out to be between 2.5. Does that answer your question?
It does answer my question. And I just have a small follow-on question. Okay. So what sorts of discount rates were used? I mean, I guess all of that is included in the 2.5 to 3x multiplier. So it just insights into discount rates that were used for 5-10 years down the line for that particular landowner. You were saying you calculated the net present value of income 5 years down the line.
Yes.
So I'm assuming you guys used some sort of a discount rate for coming up with that particular value.
No, I used the present market conditions, and then I estimated that same amount, assuming that there would be no discoveries or other things that abandon it, that everything stayed the same. Because remember this, if a discovery is made close by, then all the acreage increases in value. And then I have to start using other.
Thank you, Jay.
Next question, please state your name.
John Bob Hart. I'm just kind of following up on his question. I think he maybe was alluding to what discount factor did you use? 8%, 10%, or whatever to bring it back to present day.
I basically used 10% because it was a landowner, and sometimes I would use even a slightly less one, around 8, but just in that 8 to 10% range. If it were an oil company or corporation, a paper industry that owned the land, I would use a higher discount rate on the basis that the discount rate has to have some relationship to the cost of capital for either industry or private landowner.
Okay, thanks.
I'm Don Warnken. I had a question. It wasn't quite clear to me, John, as to why you divided your value, your lease bonus value by 0.71.
By the 71%? Okay. I can find that by pressing escape and then go back to this slide here. I don't know why it doesn't come up. There, good. Okay. And you can see there. Oh, too many hands here in the kitchen, so let's go down. Here. And now I will, well, okay. I have, let's yeah, okay. Here it is, Don. You see that we have the relationship here between the landowners 75% and 67%, and we are right smack in between those two, so that's why I called it 71%. That's the answer to it.